Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in plain sight within those massive corporate filings. Get ready because today we're diving into Jaguar Health's latest proxy statement, and let me tell you, there are some interesting moves being made behind the scenes. So, what is the big deal with this filing? Well, Jaguar Health is asking its shareholders for the green light on some pretty significant stock issuances. Think of it like them asking for permission to print more shares, and the reasons behind it are tied to investor deals and Nasdaq's rules. We're going to break down exactly what that means for you, the shareholder, and what the potential impact could be. Alright, let's get down to business. This document is a preliminary proxy statement. Basically, the company is getting ready to hold a special stockholder meeting, and they need your vote on a few key proposals. They're laying out their case for why you should vote yes, and we're here to decode it. The company we're looking at is Jaguar Health Incorporated. They're hosting this special meeting to vote on some important financial maneuvers. The meeting is scheduled for the 8th of December 2025, but they're sending out this information in November. The first major item on the agenda is about approving the issuance of their common stock. This stock is tied to something called Series N Perpetual Preferred Stock, which was issued to certain investors. This approval is specifically needed to comply with Nasdaq listing rule 5635. Now, what does that rule generally mean? It is often about making sure that when a company issues a significant amount of stock, especially in private deals, shareholders get to weigh in. It is a safeguard to prevent massive dilution without a shareholder vote. Next up, they need approval for another stock issuance, this time related to something called new PIPE shares and a pre-funded warrant. This also falls under that same Nasdaq rule, 5635. PIPE stands for Private Investment in Public Equity. These are private placements where sophisticated investors buy stock directly from the company. The pre-funded warrant is essentially a way to buy more stock later. Again, the core issue here is that these issuances might be significant enough to require shareholder consent under Nasdaq rules. The third proposal is a bit of a backup plan. They're asking for permission to adjourn the meeting if they don't get enough votes to pass the first two proposals. This is a common tactic to give the company more time to convince shareholders or secure more votes. Now, let's look at who gets to vote. The record date was the 31st October 2025, so if you own shares on that day, you get a say. It is interesting to see they're tracking not just common stock, but also different series of preferred stock, series L, M, and N, and how they vote. Here is where it gets a little complex. Different types of stock have different voting powers. For example, each share of Series L preferred stock carries a hefty 3787 votes on an as-converted basis. That is a lot of power in one share, but there's a catch, a 9.99% voting cap. This prevents any single holder, along with their affiliates, from controlling more than 9.99% of the company's voting power. This is a common way to prevent a single large shareholder from dominating every decision. Similarly, Series N preferred stock gets 1,428 votes per S-share, but with a higher 19.99% voting cap. These caps are crucial because they limit the influence a large preferred shareholder can exert over common stock votes. This is an important point about voting. All three proposals we discussed are considered non-routine. What that means for you is that if your shares are held by a broker or bank and you don't provide instructions on how to vote, your broker cannot vote your shares on these matters. This is why it is so important to return your proxy card or vote online or by phone. A broker non-vote means your shares won't be counted for these specific proposals, even though they'll be present for quorum purposes. Let's delve into Proposal 1 specifically. This is about approving the issuance of common stock from the exchange of Series N preferred stock. The vote needed here is a majority of the votes cast with a quorum present. Abstentions and broker non-votes don't count towards the approval, but they are important for determining if there is a quorum, which is 1/3 of the voting power. Interestingly, the Series N preferred stock itself cannot vote on Proposal 1, even though it is the instrument that triggers the potential issuance. This is a specific Nasdaq rule exclusion. Then we move to Proposal 2, which is for approving the new PIPE shares and the pre-funded warrant. This also requires a majority of votes cast. Again, abstentions and broker non-votes do not count for or against the proposal, but they do count towards the quorum. And Proposal 3, the adjournment proposal, requires a majority of the votes cast, excluding abstentions and broker non-votes, again provided a quorum is present. This proposal is essentially to ensure they can keep the meeting going if they need more time to get the votes for Proposals 1 and 2. It is also worth noting that for these corporate actions, stockholders do not have the right to dissent and demand the company buy back their shares for an appraised value. This is typical for these types of transactions, but good to be aware of. Like most company filings, there is a section on forward-looking statements. This is essentially a disclaimer that projections and future expectations might not pan out. They're warning that actual results could be very different due to various risks. They point to their 10K and 10Q filings for more detailed risk factors. Now, this is often the most interesting part for many viewers: who owns what. This table shows beneficial ownership as of the 17th of October 2025. We're looking at common stock and 3 series of preferred stock L, M, and N. We see Streeterville Capital LLC holding a significant chunk of Series L preferred stock, 99.3822, shares representing 81.88%. They also hold a notable amount of Series M90 shares at 34.62%. Then Therese Iliad Research and Trading LP holding 22 shares of Series L, which is 18.12%, and a whopping 170 shares of Series M, accounting for 65.38%. These are substantial stakes in the preferred stock. CVI Investments Inc. holds 147,000 shares of common stock, or 3.94%. Lincoln Alternative Strategies LLC has a large position in common stock, 710,374 shares, which is 19.02%. Brownstone Capital Limited holds 641,025 shares of common stock, or 4.99%. They also have the potential to hold more through prepaid warrants, with limitations discussed later. Martin Dunn holds 227,643 shares of common stock, about 4.99%, and also some Series N preferred stock, 200 shares making up 21.03% of that series. The John D. and Linda W. Gruber Trust holds 119,924 shares of common stock, 3.15%, and 100 shares of Series N preferred stock, 10.52%. And WBW Trust Number 1 has 299,770 shares of common stock, 8.03%, and 140 shares of Series N preferred stock, 14.72%. EJM 2012. Trust has 62,657 shares of common stock, 1.65%, and 80 shares of Series N preferred stock, 8.41%. Joshua Mailman himself holds 64,715 shares of common stock, 1.70%, and 80 shares of Series N preferred stock, 8.41%. The Joshua Mailman Foundation holds 63,848 shares of common stock, 1.68%, and 80 shares of Series N preferred stock, 8.41%. The Roy and Ruth Rogers Unit Trust has 55,286 shares of common stock, 1.46%, and 20 shares of Series N preferred stock, 2.10%. Roy L. Rogers 2020 Dynasty Trust holds 110,574 shares of common stock, 2.88%, and 30 shares of Series N preferred stock, 3.16%. Roy L. Rogers Survivors Trust has 129,003 shares of common stock, 3.34%, and 40 shares of Series N preferred stock, 4.21%. Now for management, Lisa A. Conte, the CEO and president, holds 39,196 shares of common stock, 1.04%. Pravan Chaturvedi, PhD, holds 15,475 shares. That is a small percentage, but significant for an executive. Stephen R. King, PhD, has 15,445 shares. Jonathan S. Wallen holds 37,466 shares. Carol Lizak has 6,083 shares. James J. Boknowski holds 110,952 shares, which is 2.89% of the common stock. Jonathan B. Siegel has 37,762 shares, 1.00%. John Mysick III holds 37,762 shares, 1.00%, and Anula Jayasuriya has 886 shares. Altogether, all current executive officers and directors, a group of 9 people, hold 301,027 shares, which is 7.46% of the common stock. This gives us a good snapshot of who has a stake in the company. Let's get back to the proposal, starting with Proposal 1. This is about the company potentially exchanging or redeeming shares of that Series N preferred stock. For common stock, they did a private placement back in September 2025. Selling 950.8 shares of Series N preferred stock for about $2.38 million. Now, the company has the right, after getting stockholder approval and under certain conditions, to exchange these preferred shares for common stock. The exchange ratio is based on a stated value of $2,500. per S-share of Series N preferred stock divided by an exchange price of $1.2 per S-share. A key detail here is the maximum percentage. Holders can't end up owning more than 19.99% of the company's common stock after an exchange or redemption, taking into account all related parties. It is another cap designed to manage ownership levels. The implication here is quite direct. If shareholders vote no on Proposal 1, the company cannot issue common stock for these preferred shares. This means the existing preferred stockholders might not be able to convert their holdings as planned. This section really highlights the potential downside for existing shareholders. The exchange price can be fixed or based on a minimum price at the time of a mutual exchange. If that price is low, a lot more common stock could be issued, significantly diluting the ownership percentage of current common stockholders. They even provide an example. If all 950.8 shares of Series N preferred stock were exchanged at a hypothetical price of $0.5 per S-share, it would result in issuing 4754000 shares of common stock. That is a huge number, and it would represent a massive dilution. To put it in perspective, based on their outstanding common stock at the time, this single exchange could result in over half of the company's stock being issued. This dilution fear is a significant factor in any vote on such proposals. Moving on to Proposal 2, this concerns the new PIPE securities. Back on the 28th of September 2025, they entered into an agreement to issue 161,583 shares of common stock, and a pre-funded warrant to purchase up to 479,442 more shares. The purchase price was $1.56 per S-share for the common stock, and slightly less for the warrant. Again, there is a beneficial ownership limitation, this time at 4.99%, which can be increased up to 19.99%. This is to manage ownership concentration. The company states that these particular shares by themselves are less than 20% of their outstanding common stock. However, they are seeking approval because of Nasdaq's aggregation rules. This means that if they conduct other private placements within 6 months of this deal, those might be combined with this one to see if the total issuance crosses the Nasdaq threshold for required shareholder approval. Getting this initial approval helps them avoid potential future complications. So approving Proposal 2 essentially locks in this specific transaction's compliance with Nasdaq rules, regardless of future private placements, simplifying things for the company. If they don't get the approval and then do another private placement, the two could be aggregated, potentially triggering a Nasdaq issue. Finally, Proposal 3 is the adjournment vote. This is a fairly standard proposal that allows the board to postpone the meeting if they are close to getting enough votes, but not quite there. It gives them more time to lobby shareholders. The vote required is a majority of votes cast, excluding abstentions and broken non-votes. Looking ahead, they've also included information about submitting proposals for the 2026 annual meeting. If you are a shareholder and have something you want to bring to a vote, there are deadlines for submitting those proposals, both for inclusion in the company's proxy statement and for presentation at the meeting itself. They also remind everyone where to find their full annual report and other filings. This is standard practice to ensure shareholders have access to all relevant information. And finally, a note on householding. This is an environmental and cost-saving measure where multiple shareholders at the same address might receive only one copy of the proxy materials. If you prefer separate copies, they've provided instructions on how to request them. So, what is the story here? Jaguar Health is navigating a complex landscape of investor agreements and stock market rules. They need shareholder approval to move forward with crucial funding and restructuring deals, particularly involving their Series N preferred stock and a recent PIPE offering. The core tension is between the company's need to raise capital and potentially restructure its balance sheet and the shareholders' concerns about dilution and the equitable treatment of different stock classes. The sheer volume of preferred stock and the intricate voting rights associated with Series LM and N preferred stock, along with the voting caps, indicate a company that has relied heavily on structured financing. This can be a double-edged sword. On one hand, it helps them secure funds when traditional equity markets might be challenging. On the other hand, it can lead to complex shareholder structures and potential conflicts of interest. As we saw with the voting limitations, the key concern for common stockholders, and something they are clearly signaling, is dilution, the potential issuance of millions of shares, as illustrated with the Series N preferred stock example, can significantly shrink the ownership stake of existing common shareholders. While the company is trying to present these as necessary steps for the business, the impact on existing equity can be substantial. The dual approval needed for Proposals 1 and 2, tied to Nasdaq's Rule 5635, highlights the importance of these issuances in the eyes of the stock exchange. It suggests that these transactions are significant enough to warrant a shareholder vote. The company's proactive approach in seeking this approval, even if the immediate issuance doesn't meet the 20% threshold, is a shrewd move to preempt potential issues with future financings. Overall, Jaguar Health seems to be in a phase of strategic maneuvering, likely aimed at strengthening its financial position and ensuring compliance. The success of these proposals hinges on the shareholders' perception of these deals as beneficial for the company's long-term health versus the immediate concern of dilution. The higher voting power of preferred shares, while capped, still gives them a significant voice in these matters. Investors should pay close attention to how the vote unfolds and the company's subsequent actions, as these decisions will shape the future cap table and the potential value of their stake. What is your take on these proposed stock issuances and the potential dilution for Jaguar Health shareholders? Do you think these moves are in the best interest of the company? Let us know your thoughts in the comments below. If you found this breakdown insightful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community, the link is in the description. To keep the conversation going, thanks for watching and we'll see you in the next one.